Okay, great. I think this works. Okay, great. So thank you, Kian, and thank you also to our events and marketing teams for helping hold this event. You know, they worked very hard to put this all together, so big thanks to them. And like Kian said, I'm here with Alston, who will be presenting with me today. So I guess moving into today's presentation, some topics will be mixed between beginner, intermediate, and advanced topics. So hopefully we do touch on some new and exciting ideas that you do want to explore into the future. So, but before we, get into the table of contents, let's quickly look at this table here. There's a bunch of names. Some, you might recognize better than others. I'm sure, Warren Buffett, you might have heard of. Michael Burry, you might have heard of through the GameStop fiasco. Maybe even Ken Griffin, right? Also involved with the GameStop fiasco. But I guess the goal here is really to illustrate that, everybody has made their fortunes in different ways, right? And all of them were involved in equities, but if we look at Peter Lynch and Warren Buffett, they have very similar philosophies where they want to take high quality growing businesses and buy them at a discount and to hold them for a very long time. Michael Burry has a very similar approach. He's a very deep value oriented investor, but he does not shy away from different instruments such as mortgage-backed securities, which is how really he got well known, right? And Stanley Druckenmiller, very sharp guy. Um, he takes more of a macro approach, but equities is very much within his repertoire. And Ken Griffin, of course, hedge fund guy. He just hires a bunch of mathematicians and software developers to create, algorithms that trade for him. So again, everybody has their own methodologies, and the key is really finding what works for you. And of course, there is really no shortage of money to be made with equities. So in terms of table of contents, we want to look at equities first today. We want to look at the methods of analyzing equities. Then we'll go on to valuations, and then finally we'll look at some basic strategies. So on a high level, relatively speaking, equities or shares are a small portion of a company that are available to be purchased or sold in a country's stock exchange, right? You'll often hear the terms equity, stocks, shares. They're going to be used interchangeably, but they generally have the same meaning. And so we're going to do the same throughout the presentation as well. And the portion of a company you're usually buying is very, very small. For instance, a company like Apple has 15.6 billion shares outstanding. If you buy one, that's really just a rounding error, right? Like um, one share is really a drop in the buckets, right? But compared to bonds, equities are entitled to a firm's profits, right? Whereas bondholders are typically only entitled to the interest payments that the bonds, you know, account for, right? And that's a very important distinction to make because bondholders have this buffer room in terms of being paid out first. Equities are typically more volatile and may not be suitable for everybody. And in terms of equities or stocks, there are two main types, common stocks and preferred stocks, and we'll get into that in just a second here. So before we cover the chart on the left, let's quickly look at the pyramid on the right. And this is what we call a capital structure. So when we think of a company, it usually has debt holders and shareholders, right? So bonds and equities. What this chart tells us is in the event of a bankruptcy, who gets legally paid out first, right? And it's the bondholders first, and then it goes into the preferred stock, and then it goes into common stock, right? So, this trickle down is true for every single company. And as a bondholder, you are taking less risk. And so to compensate for that, you need to get paid out first in order in the event of a bankruptcy, and common stock gets paid last. Now, turning to the charts on the left, you'll see that preferred stock is generally less volatile, and you'll see that they're often guaranteed a dividend and usually has less liquidity. And so depending on whether you are a frequent trader or a long-term investor, your view on these assets or these two different stocks will differ, right? Long-term investors may find a reason to buy preferred shares, whereas active traders might enjoy common stocks more because it's more volatile and has more liquidity. So now let's go through some quick important terms. And these are some terms that are generally quite useful for all types of equity investors or traders. it's quite common across every single type of trader there is, right? So market capitalization really is just um, a measure of the total value of a company, which is basically just the share price times the number of shares outstanding, right? And bid-ask spread, which is the difference between the price and the price buyers can buy at and sellers can sell at, right? So if you think of supply and demand, what price do these two parties match at, right? And so this spread, this difference in price is what we call the bid-ask spread, right? And so a large spread can often be unfavorable and is generally indicative of low liquidity. Volume is really just the number of shares that are traded for a stock. Higher volume means more liquidity in the markets, which is definitely more favorable. You don't want a stock that has low volume because you'll be stuck in positions where you can't get out at a reasonable price, and you'll be taking significant losses. So now beta. Beta is the expected move in a stock relative to the market, right? And so relative to the S&P 500. So what this means is the S&P 500 has a beta of 1, and individual stocks will have a beta that revolves around that, right? So, tech stocks such as Microsoft or Google may have a beta that's higher than 1, and then very slow moving stocks such as, like a TELUS, like a Bell, like a Enbridge. These are stocks that don't really move much, and so their beta is going to be a bit lower. Dividend yield is really just the annual dividend an income investor can receive, and is denoted as basically the dividend amount that you receive divided by the price. And this is very important, especially for long-term investors, because we want to sort of know how this dividend yield fares against its competitors. And liquidity is, of course, a very important term, as I have already mentioned this several times. But we want to look at liquidity because, in order to get filled for positions or for stocks that you want to buy or to sell stocks that you don't want to own anymore, you need sufficient liquidity to cover your trades, right? Because if you don't have enough liquidity, ultimately what ends up happening is that your stock, your position, you get forced to pay really bad prices and you take very big losses that way. So in terms of common types of equities, we'll look at just types of equities out there, such as public equities, private equity, venture capital, and I put bond markets here just to sort of illustrate the difference in sizes, right? And so you'll see here, public equities at 112 trillion, private equity at 10 trillion, venture capital at 230 billion, right? You're looking at a 10 times difference between public and private, and then like a 40 times difference between private equity and venture capital, right? So there's a lot of money sloshing around in public equity markets and much more in the bond market. So, as private equity firms continue to expand and more money flows into private equity, it's very interesting to see how cash gets allocated in the future and sort of how individual investors might get involved in private equity in the future, right? And just, this chart here really just shows venture capital isn't even on the charts. So let's look at the role of equities, or why we want to use equities, and what is its role, right? And so we want to explore this because it really helps us better understand how equities, this specific instrument, plays in our portfolio and how we can use it to its full potential. Just like how we want to understand the role of options, we want to understand the role of bonds or commodities or forex in our portfolio. We can do the same with equities, right? So for the long-term folks, equity offers portfolio diversification. It offers potential for dividend income, and this is very beneficial to the older generations or older folks, or for people who really want just steady income streams, right? Equities can do all of that and still give you capital appreciation. Of course, equities are more volatile and risky, which is exactly what some people want or need, especially, if you're younger, you can afford to take few more risks, right? You buy a stock that's a little bit more risky, but you have the opportunity of really ballooning this position as a company continues to grow in the future, right? And then finally, they can also act as a method of preserving capital. I know it's a little bit counterintuitive. Normally you store your cash in savings accounts to preserve capital, but depending on what you buy and what your timeline is, a long-term investment in something like the S&P 500 really beats inflation and generates a few percent of real returns for the investor, right? So in terms of for active strategies, equities have higher returns and are generally more volatile versus most asset classes, and you want, oh, this is not updated. Oh, geez. But for active traders, volatility is very useful to to uh, to generate higher returns, right? And if you're a macro trader, you'll also notice that equities move closely to economic data such as inflation data or jobs reports data. And the index funds are typically a very good way to trade around this data. So now let's look at some methods of analyzing equities. You've probably heard these terms being thrown around often, right? Fundamental analysis, technical analysis, even quantitative analysis, right? Like, what do they really mean? And looking at fundamental analysis, it really just looks at companies' financial statements, looks at industry reports, looks at the broader economy as a whole, and you're using these numbers to create a compelling story, right? That's the general gist of fundamental analysis. Technical analysis uses candlesticks and patterns or other chart indicators to determine entry and exit points, right? It's typically not as used in in institutions, but is very popular in prop trading, proprietary trading, or just for individual traders, right? And then quantitative analysis uses large data, uses algorithms and mathematical formulas to determine entry and exit points. So like I mentioned earlier, Ken Griffin, founder of Citadel, he has a hedge fund that uses a lot of quantitative analysis. They do a lot of research using, big data and creates, algorithms that can trade without, that can trade systematically, right? So in terms of your time frame or holding period, you can see how quickly this moves down, right? Fundamental analysis is typically longer frame. You want to be looking to exploit any market inefficiencies regarding inefficiencies with company numbers or economic numbers. Technical analysis is generally a bit shorter in nature, right? Because candlestick patterns are very reactive, and so they either turn out well or they turn out to be losses. So you get a better understanding of your position very quickly. Quantitative analysis is mixed because you can generally find strategies for all time frames, and yeah. So let's move on to fundamental analysis here. So we know fundamental analysis uses numbers, right? But what a lot of people what a lot of investors struggle with is creating a story around these numbers, right? Why do we care about these numbers? How can we generate insights from these numbers? And so that's a skill that's necessary when it comes to, this strategy, right? And it's not just numbers from financial statements. It's also interpreting macroeconomic data or creating a story around industry data, right? Why do we care about for example, we have Apple here. Why do we care about the semiconductor shortage, or why do we care about production shifting to Vietnam, right? And these are just questions that you have to ask and find answers to. But looking at Apple's income statement here, we see revenue going up, right? Gross margin is growing up. But let's look for a second at their cost of goods sold, right? Their cost of goods sold as a percentage of revenue is declining year over year, and that's a good thing, right? But as an investor, why do we care about this? Is because as cost of goods sold decrease, it means that their business is becoming more efficient. And we know that Apple is shifting from a hardware business to a software business. We know that they're shifting away from selling iPhones, Macs, iPads. That's all very important, but understanding that they're having a very big emphasis on subscriptions, right, such as iTunes, Apple TV, and all this other ecosystem subscriptions are very important. And this is reflective of their transition. And because these subscriptions have generally lower cost of goods sold, you can sort of tell that the transition is going well for the business, right? And that they're executing on their long-term plan. And so, but if you presented this number as is, right, and you don't give any context, if you don't get any context, we don't know the importance of it. And you might also, look at this income tax expense as well, right? Earnings before tax increases by 42 billion from 2020 to 2021. Yet, earnings before tax increases 10 billion from 2021 to 2022, and we see this. We see an equivalent growth in income tax expense, right? Even though earnings before tax is not a proportional increase, right? So why is that? I'm not sure, but this is stuff that you have to ask. These are questions that you have to ask to find stories around these numbers and to determine, what it is that's so relevant and important about these numbers. So now moving on to technical analysis, also very useful. Personally, I don't use it as intensely. I use it more as a sanity check to see where the stock is trading, visually on a charts. I don't use it as a primary indicator, but other people find it very useful. But yeah, so technical indicators are really just mathematical calculations based on the stock or security, such as what we see on the right, right? Samples of technical indicators could be just very simply moving averages that are shown on a charts, and you can use the moving average crossover as an indication of when you want to enter or exit a stock, right? This is just one of many examples that you can use it for, and they're often lagging indicators. And traders use technical indicators to get a general picture of the trend and helps you with decision making, right? And so some examples here, as I mentioned, moving average, relative strength index, moving average convergence, and divergence as some examples. They're not here, but yeah. So there's no perfect strategy. Really, ultimately, it is based on what works for you, what you find to be the best, and so it takes a lot of exploring and seeing what fits your own philosophy, what fits your own trading style, and it takes time to develop the indicators that work for you. So now moving into valuation methodologies, let's look at the three most common methods. So again, if you're in accounting or finance, or if you're in economics, chances are that you've heard of these thrown around quite often: the discounted cash flow, the company comparable, and precedent transactions, right? So the DCF, of course, is forecasting future free cash flows and then discounting them back to the present. The beautiful thing about running a DCF is that it doesn't require market data, right? We can use historical data and project forward, and is especially useful if we don't have access to any competitors. Company comps is really just comparing a company with peer companies, in similar industry with similar stats, such as, similar industry, similar size, similar business model, and then we want to then compare them using different multiples such as price earnings, price sales, price book. And it's a really quick and dirty way to see who is overvalued and who is undervalued in the industry, and it's a very quick way just for you to get a better insight of what's happening in the industry, right? And now precedent transactions basically assesses the potential value of a company through the context of a mergers and acquisition, right? And so if you're looking at private equity, for example, there's no publicly traded comps for a lot of these companies, right? And so what you'll do instead is look at what previous companies have been bought for, what prices that they've been bought for, and use that as a guide for, what you think your company should be worth, right? And it's especially useful, without public information on competitors. So let's look at the DCF a little bit. So in a nutshell here, the DCF method applies the time value of money principle by forecasting cash flows into the future. And then we discount the cash flows into the present to determine a fair stock price. And so you'll see the chart on the left, a very, very simplified version of this. The present value of the cash flows decreases as time goes on, which is normal, right? And, when you start discounting it into the future and you apply this exponents, the value of the cash flows will generally decline over time. And this method is extremely powerful, but also very sensitive. And I guess why is this, right? Well, when you make a DCF, it requires a lot of inputs and assumptions, right? Whether it's financial data, industry data, and these assumptions get projected 5 to 10 years out and can easily get out of hand, um, especially if your assumptions are wrong or inaccurate, right? And so your output can be wildly off compared to what the actual result is 5 to 10 years out. So you'll see that ultimately the DCF rewards high quality assumptions and inputs and ultimately punishes sloppy assumptions by giving inaccurate outputs. As the saying goes, garbage in, garbage out. It's very commonly known in the industry for DCFs. And then you might ask a following question then, well, if the DCF relies on very accurate forecasts and we can't predict the future, why do we still use it, right? And the ultimate answer is because the DCF is a very reliable method in performing sanity checks, right? And so sanity checks are there to keep you accountable and to basically see whether or not your analysis is reasonable and allows you to really dive into every aspect of the business and to force you to ask yourself whether your assumptions are too optimistic or pessimistic, right? For example, if you do a DCF on Apple, the largest company on earth, and you forecast a share price increase of 500% over the next 5 years, well, you have to ask yourself whether you did something wrong, right? Because for a company of that size to grow that much is very unlikely. But similarly, if you do a DCF on a company like Enbridge, right, a very stable company, and you forecast something like a 80% drawdown, well, likely you're too pessimistic. And so, these are questions that we have to ask, and the DCF helps us do a sanity check, see if we're on the right path. But with that said, I'll pass it over to Elston to do a deep dive on the DCF in terms of the technical parts. You might want to take notes here because it does get a little bit involved.
Thank you. Yeah, so as Nick already said, we're projecting cash flows out because we care about the company's ability to produce cash in the future, and then we discount everything back to the present because of the time value of money. So the way we do that is by step one, we have to project free cash flow, which ultimately starts at the revenues. And it's very important that we get our assumptions right. This could be the hardest part of making a DCF is how do we project our revenues? So we would have to look at how the industry is doing, how comparable companies are doing, and just create like a reasonable growth rate in our revenues that we deem to be realistic. So then we can use the formula and work our way down the sheet to arrive at our free cash flow for year X. So typically at DCF, we'll have 5 to 10 projection years, 5 years for a company that maybe isn't too stable in terms of their revenues, and 10 years for a more mature company. That's you don't have to do 5 to 10 years. You can really do however many years you want, but 5 to 10 seems to be the industry standard. So then we arrive at the free cash flow, and then we can project it out for 5 to 10 years. So if you want to go to the next slide for me, Nick. So once we projected out our free cash flows, we then need to use the weighted average cost of capital as our discount rate to bring everything back to the present value. And the reason for this is the WACC is essentially the cost of the company to finance their operations. So they have to pay out dividends, for example, to the equity or interest to the bondholders. So that's why we use the WACC, because it's an all-encompassing discount rate, if you will. So when we want to calculate the WACC, it's a simple formula. We use the percentage of the equity in the company times the cost of equity, plus the percentage of debt in the company times the cost of debt. And then we also have to factor in that there's a tax incentive for debt holders, for debt issuers, sorry. So we factor that into the calculation. And for the cost of equity, it's the same thing. We just use this simple formula here that you guys can see. And then the cost of debt is just going to be the interest paid on the debt, or otherwise known as the yield to maturity. So then we just simply use this rate as our appropriate discount rate to discount everything back to the present. So if you want to go to the next slide for me. So then we arrive at the terminal value step. So the terminal value is the value of the company's future free cash flow beyond the forecasted period. So we're assuming that after this period, the company is going to grow at a set rate until the end of time, typically at 2%. And the reason this is because we're assuming that the company is not going to grow faster than the economy. So a safe growth rate, 2%, is typically used. And to arrive at this value, the terminal value, there's two methods, the exit EBITDA multiple or the perpetuity growth, and it's just a simple calculation. So our final free cash flow, and then we factor in our set growth rate. This is also known as the terminal growth rate, which is that 2% that you guys see on the screen. Then you just put everything into this formula, and then you arrive at your terminal value. Then, next slide, please. Thank you. So then we have to bring everything back to the present to tell a story. I think we're on the wrong slide there. If you want to go one back for me, please. Not that one, step 4. Seem to be having some difficulties. Yeah, next slide, please, after this one. Yeah, so now that we calculated our WACC, we forecasted our revenues, future free cash flows, we can then discount everything back to the present. So it's just a simple present value formula for each of our free cash flows for, let's say we did it for 5 years or for 10 years. We'll simply calculate the present value of our free cash flows. And then we'll also calculate the present value of our terminal value. Then all we need to do from there is use this formula you see in step 5, and then we will arrive at an implied price per share. So then what you could do is you compare the implied share price to the current share price. So let's say XYZ stock is trading at $30, but our implied price is 50. So then we can safely assume that there's room for the stock to grow to 50. That doesn't always mean it's going to be the case. Like Nick said, your assumptions are very important, and it plays a lot into the final story that you're going to tell. So you really need to focus on your assumptions as in first step, because like you said, garbage in, garbage out. If your assumptions are very bad quality, then the DCF is going to be very bad quality. So like another thing that you can do is, rather than just forecasting year XYZ revenue, you can break it down. So for if we want to do a Tesla DCF, for example, for the revenues, rather than just putting a revenue figure, break it down into what car they're selling, how much you expect them to sell. So obviously their most expensive car is going to sell less than their cheapest car. So you just want to break down the revenues like that, and that's another way to tell the full story. But yeah, that's pretty much the basics of the DCF and how you would arrive at the implied share price. And that's all from me.
Great. Thanks, Austin. Very informative. Okay, so in terms of company comparable, otherwise known as comps, is basically a valuation method that is based on the idea that companies with similar characteristics, as I explained earlier, will be compared to each other, right? So we see here the PE ratio. We're essentially comparing and seeing which companies are overvalued, which companies are undervalued. This generally gives us a rough understanding of how the industry is looking like and can invite further questions to see why a company is overvalued or why a company is undervalued. And so, yeah, it's a very quick and dirty way. This shouldn't take too much time. Maybe you're looking at like half an hour to build something out like this, maybe even less. So very easy way for investors to get a high level view of what's going on. And then finally, precedent transactions is the last method of valuation, right? And so ultimately, our goal is to see, what the fair value or fair price of a company is by looking at previous transaction deals, right? And so companies typically do report some very, very basic details about the deal, such as the price, such as their earnings, and then you can sort of use that to back out what type of ratio they've paid for it. And so if you look at this list here, there's a bunch of PE ratios, price earnings ratios, and the average seemed to be 42.3. And so you can sort of make a rough guess, or you can sort of assume that's roughly a 42 times earnings price is fair value for a company that's, I don't know what they do, bottling? Non-alcohol, yeah. In order to buy a company that's non-alcoholic, I guess a 42 times price earnings ratio is fair, right? So that's sort of analysis that you would do for precedents. So now looking at exchange traded funds, it's a very simple concept. It's just a basket of stocks, right? Um, you know, really, you just buy the S&P ETF, right? Like SPY, VOO, or you buy the NASDAQ, which is QQQ, right? Should be simple as that, right? But no, not exactly. If you're an individual investor and you are trading with Questrade or you're trading with Wealthsimple, um, and you want to buy something like bonds or something like commodities, how do you do that, right? They don't allow something like that on their platform. So the easiest way you can get exposure through some of these asset classes or some of these different sectors is really through ETFs, right? Because in this day and age, there's so many ETFs that have so many different, um, offerings, right? So if you want fixed income ETFs, you can find that. If you want commodities ETFs, you can find that. Currencies, sector specific, right? If you want leveraged ETFs, you can find that. If you want to buy like a geographical ETF, such as a Japan or Canada ETF specifically, you can do that, right? And so there's just so many ways you can find diversification and to get the exposure you want, right? Um, and then also ETFs gives you the opportunity to diversify your portfolio and improve your risk management, right? So ETFs generally hold lots of positions, and so naturally they're more diverse, and you can choose how much money you want to put into each ETF, and that way you can sort of divide and conquer and get as much allocation towards different um, stocks that you want, right? And then also another benefit is lower trading costs because you are buying so many companies, um, but you're not buying them individually, right? If you were to buy Apple, Microsoft, Facebook, Google, Adobe, Netflix, all these companies in the S&P 500, that would be very expensive. Whereas you can just buy an ETF that has all of that for you, and um, you save a lot of trading fees. So another, I guess, follow up to this is like when might you want to use an ETF? I guess this does follow why you want to use ETF. But like I mentioned before, if you need bond exposure, but you don't have an ability to purchase bonds, then you'll purchase a fixed income ETF such as AGG, ETLT, BND, HYG. There's, thousands out there that can serve your needs. If you want to buy commodities, you can buy something like BOIL. It has exposure to like natural gas. CORN has exposure to corn futures. So, there's really um, you know, products for everything out there. So now let's look at what moves equity prices. I think this is something that is very important to know, and there's a lot more than you initially think, right? So starting off, changes in the company or industry outlook, very obvious, right? Like if an industry is very bullish in the future, this is going to get reflected in the company's stock price. If a company reports better than expected earnings, their stock is going to move up. Um, and then there's also interest rate cuts and hikes that affect equity prices. There's a few theories that are very plausible, that are very used, but on an accounting and finance level, on a fundamental level, when you increase interest rates, it reduces the present value of cash flow. So this again goes back to the DCF, right? And so when your present value of cash flows decrease, consequently your stock price must fall as an inverse effect, right? And so um, but conversely speaking, when there's interest rate cuts, right, when interest rates go down, then stock prices generally follow up. Um, and then macroeconomic data also very important. Um, it's a very big one. Data such as non-farm payrolls, which tracks unemployment reports, unemployment rates and inflation rates are also very important, especially in these past couple of years, right? High inflation is generally not very good for stocks because it means that their expenses go up, and this does not bode well for their stock price. And then also high unemployment is also not good. And so, when you're looking at something like unemployment rates or CPI, you're looking at almost like a Goldilocks level, right? CPI or inflation typically should be around the 2% range. Unemployment rate, you would expect to be around the 5% range. So if you deviate too far from both numbers, whether up or down, it's going to have a very surprising effect on stocks, and generally stocks do not do very well when there's large shocks like that. And then looking at market liquidity, very simply, if there's lots of demand for a stock, stock goes up. There's lots of supply, then stock goes down. But then also quantitative easing, right? So if you're in economics, again, you'll hear this term a lot. And this is essentially the idea that the central bank buys bonds in the open markets. And this affects stock prices because when there's the central bank stepping in to buy bonds, then uh, there's more money that's freely available to be used to purchase stocks, right? And so that's quantitative easing. Quantitative tightening is the inverse when the central bank sells bonds into the open markets, and this affects liquidity in general, right? And then finally, market sentiment moves prices and is increasingly a factor that a lot of firms or even individuals use, right? So social media sources like Reddit, Twitter, Telegram, Discord have a very strong effect in creating FOMO. And you know, you want to sort of follow it just to see what's going on and just to see, what stocks like GameStop, like AMC, right? These names have been, very much thrown around in these social media circles, and market sentiment does play a big part into moving stock prices, especially in the short term. And then finally, let's look at some basic equity strategies. But I will preface by saying that there is no alpha leak. Um, I won't be disclosing specific like technical analysis or fundamental analysis discoveries, but uh, the goal, I guess, is really just to unravel the ways you can manage and run your portfolio, right? So for passive investing or passive strategies, the most common portfolio you can run is a 60-40, right? 60% equities, 40% bonds. It's the most common one. And the role of bonds in this portfolio is really to sort of reduce the volatility and reduce the variance within your portfolio. This is especially helpful for people who cannot stomach big sell-offs, right? And so the bonds are there to sort of cushion that. But beyond the 60-40, you have some passive strategies like Ray Dalio's all-weather portfolio, which holds gold, it holds bonds, it holds stocks and commodities, or the golden butterfly portfolio, which holds stocks, bonds, and gold, right? And you know, you don't necessarily have to run the 60-40. You can run a slider, right? If you're younger, maybe you want to run more equity and fewer bonds. But if you're older, maybe you want to run, more bonds, less equities than this, right? And so really, it is dependent on your risk tolerance. And looking at some active strategies, so this is a very big one that a lot of people can do within their own portfolio is the long shorts strategy. So essentially, what the idea is that typically um, in a passive or even active strategies, you have 100% exposure on the long side, right? So you're only buying stocks. But the short side in a long short portfolio enables you to get even more exposure on your favorite stocks, allowing you to go 130% long, 30% short, which nets out to 100% long exposure, right? And so the idea is that you can short stocks that you think will go down and buy stocks that you think will go up, and ultimately there is sort of a net effect here where um, even if one direction doesn't go your way, at least the other direction might sort of buffer some of the losses, right? And so it gives you a lot of optionality here. Market neutral strategy is a very interesting one, especially within, quant analysis. Um, the idea is that you don't want to take a directional bias, right? Like you don't care to be long or short. You want to use arbitrage. So what is arbitrage? Very simply is, if there's a buyout expected to happen, your goal is to um, play this statistical arbitrage and make a gain, not because you're betting on the company going up in the long term in terms of their company fundamentals, but because the deal is going to close and you have a um, earning amount that you can make um, between the spread. And then finally, fundamental equity is a very popular strategy that the likes of Warren Buffett's, Peter Lynch, all these guys use. Is basically stock picking based on your portfolio mandates. Of course, if you are a Institutional investor, you'll have a lot of limitations and constraints, primarily in market cap, right? Like you're generally not allowed to buy small cap stocks. And yeah, but for the individual investor, fundamental equity is pretty useful. Just doing your DCF or comps analysis to get you, to find stocks that you like. And yeah, so that's about it for today's presentation. I guess we can open the floor here to any questions, and I've listed here just a few books if you want to do any follow-up resources reading. Fundamental Analysis, One Up on Wall Street is really good. Trading in the Zone is very good for technical analysis. And then Advanced Futures Trading Strategies gives you actionable trading strategies for the quant side. So yeah, if there's any questions, I'd be happy to answer them.